Great. Ladies and gentlemen, then, I will be the one taking you through this financial management special revision, right? And a special revision, it's basically, as the name suggests here, a revision program for those students who attempted exams, financial management exams last semester or even in previous semesters, and then they deferred. In this case here, they differed in terms of opinion with who? Examiners. In short, they never did. They did not pass. So if you look at your usual kind of giving you notes class and then you write, no. This is purely technical, it's purely revision. It's purely revision. It's purely revision. Yeah, the ones who are tricked, actually that's also a very good term, yeah. Yeah, so you should be able to see in this case here then, what never, in this case here, worked for us last semester. So, and I'm looking at first, or maybe I need to also introduce myself. For those of you who have never met this Mwalimu, my name is Dr. 𝗕𝗟𝗢𝗓, Dr. Joshua 𝗟𝗢. I'm the one who will be taking you through this financial management special revision this semester. Currently, I see we have about 15 students who have paid for this special revision. This is a very, very small number, given what we do at RCM. This is not a very, very good number. So we expect you guys to get out of your way. This FM paper last semester was a killer paper. I'm so sure there are so many people who are willing to join us here. Simply get them out, fish them, get them, bring them here. So in this case here, we charge how much for this special revision? 3,800 Kenya shillings per student. If you get a person who is willing to join us, this is our pay bill. Our pay bill is 6242,839. Account number, you write FM SPR. FM special revision account. Special revision. And then you send the payment message to 0719 525,000. This semester we need to pass and pass. All of us shall pass. All of us shall pass. So I hope this information is clear. And if it's clear, now I can remove it so I can start with a job. Do these questions. And we are starting with the questions that you guys did. And I'm basically looking at if I'm the one who was doing this exam. If I was the one doing this exam, can somebody in this case here help Jumwa, who is not able to hear anything, tell her to get out of the meeting and then she comes back. Yeah. And when she comes back, there's a place of audio. Join with audio. Somebody should go type there for us. Type there for us, send to her. Send to her. All right. So if I were the one doing this paper, it was quite a tough one, but if I were the one doing this paper, there are things in this case that I would have really scored. There are things I would have scored very, very fast. Like look at question 3A. So you are told here, question 3A, Remy Limited anticipates to spend 150 million cash outlay to install a new production line in their factory. The cash outlays are expected to occur equally throughout the year. The company's treasury reports that the firm can invest in marketable securities yielding 8% per annum. The cost of shifting funds from marketable securities portfolio to cash is 7,500 per transaction. Assume that the company will meet its cash demands by selling marketable securities. So using the powerful cash management model, they want us to determine the optimal size of the company's transfer of funds from marketable securities to cash. Compute the company's average cash balance. Determine the number of transfer from marketable securities to cash during the year. Compute the total cost associated with the company's cash requirements. So then, ladies and gentlemen, I'll be able to direct as follows. As I teach this paper, even if you have said that we shall be going at questions, answers, just do a revision, I also recognize that we are coming from different colleges. It will be good for me, first of all, before I tackle a question, it will be good for me to go ahead and first of all give you some little background. And to give you some little background, I'm going to use some very, very special. If you realize your examiner has gone full 𝗕𝗟𝗍𝒂. For the last 2 semesters, your examiner has gone crazy and is really working with what here? With 𝗕𝗟𝗍𝒂 questions here. With 𝗕𝗟𝗍𝒂 questions here. So we must do exactly what he is. We must go to where he's getting his questions from. We must go to where he's getting his questions from. For us to be able to. So it is last sitting. Sorry, I never mentioned there. It's last sitting, yes. So this is an 𝗕𝗟𝗍𝒂 book that I'll be able to share to the very group. The very group. So we are told here cash management models. Cash management models are aimed at minimizing the total cost associated with movements between a current account, very liquid but not earning interest, and the short-term investments, less liquid but earning interest. The models are devised to answer the questions: at what point should funds be moved? How much should be moved in one go? The Baumol cash management model, Baumol noted that cash balances are very similar to inventory levels and developed a model based on EOQ assumptions, economic order quantity assumptions. Cash use is steady and predictable. Cash inflows are known and regular. Day-to-day cash needs are funded from current accounts. Buffer cash is held in short-term investments. And then we have the EOQ formula. EOQ formula, which is this one here, which I'll be able to write for you. After that, ladies and gentlemen, I would want us straight away to go and do this test to understanding that number one, question number one. Can you kindly take a screenshot of that question? Can you kindly take a screenshot of that question? This is a very important question. Of course, for my students who have already paid, who are in the paid group, you're going to get this book. Immediately I finish this class, you're going to get this book. Immediately I finish this class, you're going to get this book. So now that we have been able to screenshot it, we are told a company generates 10,000 per month excess cash, which it intends to invest in short-term securities. The interest rate can expect to earn on its investments is 5% per year. The transaction cost associated with each separate investment of funds is constant at 15. So what is the optimum amount of cash? Optimum means the very best. It means the most economical. What is the optimum amount of cash to be invested in each transaction? So Baumol model is really very good. It's really very nice. So in this case here, this is Baumol model. Baumol model. Under Baumol model, the first thing in this case is to get this optimal cash size. What we basically call the economic order quantity. Economic order quantity. Economic order quantity. How do we get economic order quantity? Economic order quantity. Economic order quantity. It's very easy. To get the economic order quantity in the Java, we'll take the square root of 2 CD all over I. 2 CD all over I. 2 CD all over I. All right. So the Java, this CD stands for transaction cost. Transaction cost per order. Transaction cost per order. Like ourselves, normally this is what we do as RCM college. So normally what we do is in Germany, we receive fees from our students. That's our business model. We train and we receive fees from our students. So assuming that at the beginning of the semester, like week number 1, assuming we collect 10 million Kenya shillings. So the question is, Shall we be using the 10 million Kenyan shillings, say in January, beginning of the month? No, even the whole of that month will not use 10 million. So it means that then we must take some of this 10 million amount, we take this money to where? To some say money market fund, short-term investments. So then there will be a situation where I'll be taking this case here some money like 8 million, we put under CIC money market fund. Then after some time when my cash goes low here, what do? I go to MMF, I bring that money back. So during these transfers, when you're transferring this money from the school's bank account, remember school's bank account will not be able to give me even a single interest rate. It can't give me even a single interest rate. But when I take this money to money market fund, I'll be able to get some interest rate, some interest there. So then in this case, we transfer this money from the school's account to this money market fund and the CIC. Then after some time, when we realize our cash is going low here, what do? We transfer that money back. So you see there will be transaction cost every time we order, every time we move money, the bank charges. If you're using M-Pesa, for example, if it's like say 100,000, you're using the M-Pesa charges. So then this C stands for transaction what here? Costs. Transaction costs. Okay. Do you guys have a problem? Do you guys have a problem with my network? Are you able to hear Mwalimu? I can see somebody saying network has become an issue. Are you guys able to hear Mwalimu? Because from my side, everything is very good. Because myself, I've been able to go to this Sterling. Sterling is a deal. Sterling is, you'll never see even a single day where I'm being warned that my internet is too low. No, no. So when you have a situation where you're not able to hear Mwalimu very well or something, that's when we have part, not Mwalimu here. So this C stands for that. And then we have D. D in this case, ladies and gentlemen, is a demand. Demand. So basically, we're looking at the cash demanded. The cash demanded. This cash which will be moving from me. At the end of the day, that cash that we're taking to investments, etc. So this is the cash demanded per year. Cash demanded per year. Cash demanded per year. And then we have this I, it is annual interest rate. Annual interest rate. This is the annual interest rate. So can I kindly get to know once you finish writing up to here? EOQ is the economic order, optimal cash size. All right. Once you finish writing up to here, can you kindly put a thumbs up like this? All right. All right. So only one person is putting their thumbs up like that. Only one, so I suppose he's putting up his thumbs like that. For all of us. For all of us. For all of us. All right. Then let's get back here. Thank you very much, all of you. So in this case, when you get back here. So then back here, what are we told here? A company generates what here? 10,000 per month. The keyword there is per month. Excess cash, which it intends to invest in short term. So every month, these guys will be moving from their bank account 10,000 to some short-term security investments. So then per year, that will be the total cash demanded. So in this case here, in our situation, our D will be 10,000 times 12, which gives me 120,000. That's our D. That's our D. That's our D. Always ensure that you capture those metrics very well. That's our D. From there, ladies and gentlemen, we are told here the interest rate it can expect to earn on its investments is 5% per year. You can see they have specified. So I is 0.05 per year. I is 0.05. I is 0.05. And then you can see the transaction cost associated with each separate investment of funds is constant at 50. So in this case here, we have our C. Our transaction costs are 50. Therefore, this one here will be equal to 2 times C, 50, times the demanded cash for a whole year, 120,000, divided by I which is 0.05. So that somebody, are you able to give me this from your calculators? Abracadabra. 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 So from your calculators, we get inside here, say on So 2 times 50 times 120,000 divided by 0.05, I say equals. Whatever I get here, I want square root of this number. So square root answer equals. So is there somebody who is getting 15,491.93? 15,491. 15,491.93. Okay. So much. So you're telling people this thing of transferring 10,000 every time to MMF will be very, very costly for you. You just hold on to your money until the time you hit 15,491. This is the time you transfer to the marketable securities investments. Because this is the optimal batch size, the optimal economic order quantity for cash. So up to here, ladies and gentlemen, are we really together? This is a class that I want to hold with a lot of what here, with lots of care. With lots of care. Are we together up to here? Are we together up to here? Only order quantity. Please try to respond. Thank you so much. Then now I should be able to go. And then remember, when I give you this book has got answers at the back. At the back, there's very good book. Very good book. It has got answers at the back. It has got answers at the back. So you come here at the back, you're able to get in this case at the cash. Now this one. Yeah. Like that. Yeah. Yeah. All right. But this book will only be given to those students who join my classes. If you join my classes, then automatically you're going to get access to this great book. It's free. We are giving free to all the students. In this case here, will be able to join our classes. If you join our classes, then automatically you'll be able to get access to that. That's our inquiries number. All right. And then now you come and bring the second one here. So the second question, they want us to give them how many transactions will arise each year. This is the same as number of orders. How many orders you have. If you remember very well, to get number of orders, so to get number of orders, if you remember very well, in the EOQ model, number of orders, which is the same as number of transactions, we normally take top of D over EOQ. This is the annual cash demanded, which in this question is 120,000. Divided by EOQ, already we have the EOQ figure. Which is 15,491.93. That's how we get number of orders or a number of transactions in a year. Number of orders or number of transactions in a year. So 120,000, we divide by answer. 120,000, divide this by answer. Is there somebody who is able to see number of orders? Yeah, 7.75. Fisherman 7.75 transactions. So then we shall be able to have in this case here 7.75 number of times we are making the cash transfers from the school's account to money market funds account. Great. So from there, ladies and gentlemen, we shall be able to go to the second one, the third question. The third question. So in the third question, what are they telling us here? They want us to give them the cost of making those transactions per year. The cost of making those transactions per year. Very easy. The cost of making those transactions per year. The total, that's number 3. Total transactions cost. So you take the number of transactions times C. So the number here is 7.75 times C of 50, you remember very well. Times C of 50. So approximately this will give you what figure? We have here 7.75 times 20, which will end up giving me 100 what here, somebody? 155. Don't forget, you have the answer sheet. Yeah, you have this. You have this. How did I get 7.75? Why did I use 20? I should have used, in this case here, 50. Sorry for that. But a good thing for working with these answers. 7.75 times 50. Sorry for that. It should be 387 point what here? 37.5. 37.5. And I can't remember. Just like how we used to get. So this is 387 or 388. Okay. Now remove errors. So to get this number of transactions, you can also come and imagine how we used to get ordering costs. How are we getting ordering costs? We are taking in this case here number of orders, P over EOQ, times in this case here C, or cost per order, right? So the annual demand in this case here was 120,000. EOQ, I've forgotten it was 15 something times that C. So this is a very, very important formula that you have to use. Total transaction cost, P over EOQ times C. Remembering very well that this and this gives me what here? Gives me number of what here? Number of transactions. Number of transactions. All right. From there, ladies and gentlemen, shall we be able to go to number 4? Shall we be able to go to number 4? So number 4, what do we have here? So number 4, what we have here, the last one, they want us to give them the annual opportunity cost, also known as holding cost. Annual holding cost. Annual holding cost or opportunity cost. Opportunity cost. So remember, this is based on average inventory. This is based on average inventory or cash. Or cash inventory or cash. And for us to be able to get this total holding cost, normally what we do, we take the EOQ, the cash we are holding here. You take the EOQ, you divide this by what here? By 2. And then you multiply this with what here? Rate of interest. Rate of interest is now what you stand to lose if you don't invest, or what you stand to gain if you invest. So anytime we talk of total holding cost or opportunity cost, you must always think about this. And could you kindly remind Mwalimu the value of EOQ? Now I can't work without it. Please help Mwalimu with the value of EOQ. We must be having this number somewhere. EOQ, we got it. It's 15,491. It is 15,491, 15,491.93. Divided by 2 times 0.05. Divided by 2 times 0.05. Then are you able to give us? In this case here a figure? Then be able to give us a figure. Total holding that cost, the opportunity cost. Please don't escape marketing the class. If I were you, I would have gone to the AFM financial management class that I was in last semester and sent a link there. Tell these guys here to come on, especially right now, when we want to go to our past paper. Especially right now, when we want to go to our past paper. So what figure are we getting? What figure are we getting? It should be pretty close. Should be pretty close to what we got up here. Should be very close to what we got up here. Should be very close to what we got up there. Because remember, at optimum, we expect holding cost to be exactly equal to transaction cost. So then these will actually give us approximately what we got up there. 387, 383, I can't remember very well. Like that. Great. Which sitting are we doing here? So the sitting we are doing here is last semester, August 2024, and we are doing question number 3. So the gentlemen, up to here, have you now been able to pick something? Is there somebody who has been able to understand what volume was done? Anybody who has been able to understand what volume was done very well? Kabisa, thank you very much. Then let's do the question that came last sitting. Let's do the question that came last sitting, and then we get to ask ourselves, where did we go wrong? Why did we not pass? Why did we not pass? Why did we not pass? But what shall we do to be able to pass this time around without any hitches? We don't want any hitches this time around. No hitches at all. All right. So then here we are. We are told that 𝗓𝗡 is limited. So now we are doing question 3. Now we are doing question 3, August 2024, sitting. Very easy question indeed. So we are told here, 𝗓𝗡 Limited anticipates to spend 150 million cash outlay to install a new production line in their factory. That's what they want to do. 150. The cash outlays are expected to occur equally throughout the year. So this 150 million, they have it at the beginning of the year, but in this case, you have to invest in the machine. All right. They're going to be removing this money 4 times. We are told here, the cash outlay are expected to occur equally throughout the year. The company's treasurer reports that the firm can invest in marketable securities yielding 8% per annum. Instead of this money just lying idle there, knowing very well that we shall just be moving this money to invest in the machine. Why can't we take this money? Why can't we take this money? We invest it in a money market fund. We invest in a money market fund, they will have 150 million. When in this case, the first installment is required, we go to MMF, transfer it back to a bank account, we pay the investment amount like that. Very interesting. Remember, Baumbo is really that gentleman who is against having your cash staying in the bank idle. Because the bank will never give you any what year, any interest. Baumbo is the guy who told us to ensure that we invest heavily with government securities. But then what in this case here, for example, idle cash, which you may need, for example, like after say 3 months or 4 months, you want to buy T-bills. If you need money in the long term, maybe you need this money 20 years time to come, one put it in the government for long term, buy a 20-year bond like that. All right. So then what are they telling us, ladies and gentlemen, here? They are telling us the cost of shifting funds from marketable securities portfolio to cash is 7,500 per transaction. Assume the company will meet its cash demands by selling marketable securities. 1, determine the optimality I've told you about EOQ. Determine the optimal size of the company's transfer of funds from marketable securities to cash. Very easy. So I know the formula. So I know that EOQ should be equal to 2CD. EOQ should be equal to 2CD over R. Economic order quantity, economic cash size should be equal to the roots twice CD all over R, which will be equal to twice the transaction cost. Have they given us the transaction cost per every time we make an order? How much is the transaction cost? 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 I hope you guys have this paper, 7,500. Do we have an annual cash demanded? At the end of the day, the cash we're going to be playing around with is the entire 150 million. Therefore, cash which is needed for investments, for buying of that machine, is what we shall be playing around with from the account to TDs, from the account, money, like that, is 150 million. All over I remember is an annual interest rate. So have they given us the annual interest rate, ladies and gentlemen, in this question? Have they given us the annual interest rate? Yeah, and most of you were forgetting that the 8 is percent, isn't it? So then I can't write 8. Decay, I will write 0.0. Of course, I know an exam with a bit of that. So I'll write 0.0, and then I'll be able to get that EOQ. So the EOQ here will be 2 times 70, 2 times 75, and it's 150 million divided by 0.08. Whatever I get, I will come and say square root answer. A huge figure. 530, 530, 530, 530, 33, 100.85. Is there somebody who is able to get this kind of a number? Anybody? Juman has been able to confirm. He has also confirmed. Number 1, correct. Number 1, correct. Number 1, correct. 1, correct. Then we go to number 2. So number 2, what we have here for number 2. So for number 2, we are told here to compute the company's average cash balance. Average means you take the number that you have divided by 2. Average cash balance. Average cash balance. This will be equal to EOQ divided by 2. So it will be 530, 3330, 0.859 divided by 2, which will be equal to what at the end of the day? Yeah, so whatever I have here divided by 2. So this one is 2651. 2651. 650. 650. Yeah, is there somebody who's getting something like that? Please, I want us to move together. Anybody who's getting something like this? And then I'll be able to share with you resources. I always like being a resourceful teacher. That is actually why so many students like here. So my class will always go to 200 students. Although this one, especially you guys haven't marketed it. So like now you can see the distribution. These guys are very good. You can see this one. Yeah. Any 2 at 1, you get it 4 marks. Any 2. You can see the formula gave you a mark. Yeah. You can see that now the average balance. This formula gave you a mark. Then the answer. Yeah. That's any. Even if you got this wrong, but you had a formula correct. I'm telling you, at times failing class is not easy. You really have to fight a lot. In this case, you fail. Has never exam at times, not always, but at times. Because they're very, very flexible, very liberal in terms of how they award their marks. So long as you keep on writing formulas, you keep on doing things, then automatically the examiner is very, very liberal. All right. All right. Okay. So number of cash transfers. The third one, they want us to give them the number of what year cash transfers. The third one, they want us to give them the number of cash transfers. Very easy. Number of cash transfers. So basically, these are number of transactions. These are number of orders. So what you need to do here is to come and write number of orders. So come here and write number of what here? Number of orders. Number of orders. Number of orders. So what here? Transactions. Number of orders of transactions, which are D over EOQ. So annual demand is 150 million divided by our EOQ that I'm so sure I have a graph. No, I have it. Our EOQ is 530, 530, 33, 100. So we take 150 million. I divided this by 107. So, so it is 150 million divided by 530, 0.85. $28 times. Somebody getting 28 times 28.28. I mean, I think I'm alone. I think I'm alone. 28.28 transactions. Yeah, 28.28 transactions like that. Then lastly, they want us to compute the total cost associated with the company's cash requirements. Just like you normally do it in management accounting, how do we get this number of what here? Number of transactions, or rather number of the total cost, I mean, how do we get the total cost? How do we get the total cost? So this will be transaction costs plus holding costs. So this will be D over EOQ multiplied by C plus EOQ over 2 multiplied by R. Very, very easy. Multiplied by R. Very easy. So this is the annual demand. So this is 150 million divided by EOQ. What is our EOQ? Our EOQ, we know it, it's 530. 3,300 plus 530 0.859. So plus 530 3,300 0.89 divided by 2 times R. And the rate of interest you guys are given this to me as 0.08. As 0.08. And if you are keen, the cost here, whatever we get here, will be exactly equal to the cost on the other side. The two must always be equal. The two must always be equal. So can somebody get ahead and just do everything, and then they just give me an answer in shillings? How much do we have there? In shillings, how much do we have there? The Ksnev's answer can just be the Ksnev's answer. I can just be giving you the answer here. Yeah, it's approximately, in this case here, 424,381. Around there, 424,381. Thank you. Let's see a question here. Of the C, how would I forget it? There is C here. So C. Remember, this C is a transaction cost. Are you able to remember what was the transaction cost in our case? What is the transaction cost in our case? Multiply by 7,500. Thank you so much. Yeah, this one here must be multiplied by. I just forgotten this. But the final answer should be something like 424,300 something. Can somebody in this case confirm the final answer? Somebody in this case confirm the final answer. Somebody in this case here found the final ones. Check this plus the other one. What we have there. $424, $232, or $424, $264, whichever. You know, there will always be discrepancies because of what you're rounding off. Those ones the exam appreciate. Let me ask you guys a question. Was this question really very difficult? Be very honest with me. Was this question very difficult? The better question that I should ask, if they were to bring it now in December, will you be able to get everything? If, for example, they were to repeat it in December, will you be able to get everything? Saturn was around. So come December, no problem if you guys are not connecting with me. You're not giving me responses here. If they bring it in December, the same one, similar, will you be able to score like now everything? Yeah. Great. Thank you so much. Thank you so much. Thank you so much. We shall overcome. 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 Now, part 2 of this question was really great. So part 2 of this question was really very easy. Let me ask you a question. If, for example, bread today, for example, is costing 70 over. And then in this case here, next month, it costs 100. Can you kindly give me the percentage increase in this price of bread? It's going for 70. Next month, it will be going for 100. And then they want us to give them the percentage increase in the price of bread. That AM is telling you that this bread price has risen by a whole 42.8. So what have they done to get the percentage increase? So to get the percentage increase, they have done here, they have taken price end of month 1 minus the original price. Today's price, all over today's price, times 100. Times 100. Right. So basically what they have done, they have taken this price, this is P1, and this is P0. So they have taken, in this case here, price 1 is 100, minus price 4, which is 70, all over price 4, which is 70. Which will give us 30 over 70, whatever we get, times 100. Can somebody confirm that that 42 point something is correct? Can somebody in this case here confirm that this 42.8 is correct? Somebody will confirm that this 42.8 is correct. Yeah, thank you. This is a lazy man doing this. A lazy man will work out this thing like that. A genius will always do this thing like this to get percentage increase. So you take P1, 100, you divide by P0, 17, minus 1. Whatever you get, you multiply with 100. Whatever you get, you multiply with 100. Then you'll be able to get the same answer. So remember, first of all, you know this one is independent. So you take P1 over P0, 100 divided by 70. Whatever you get, you say minus 1. Whatever you get, you say minus 1. Then you say times 100%. Will we still get the same answer? will you still get the same answer? Yeah. So these are very, very important formulas. And this is what we tried seeing whether you guys would have thought of it this way by giving you this question here. By giving you this question here. Very few students were able to do this question. Yeah, this one here. The following information relates to the market price per share of window limit over a period of 5 years. 2023 all the way to 2019, 2019 to 2023. So they've given me market prices. Then they want me to give them expected return. Expected return. They want us to give them expected return of the shares of this company. And you are told, you know, these are market prices in terms of emissions. What the research should have done, they should have come and created a column where we capture returns in the form of percentage. So then the question will be, of course, like now 2019 will be the base year. So 2019 cannot have any price increase. Yeah, this will be our base year. But when I go to 2020, I want to get my percentage return. So how do I do it? I take the new price, 25, over now the old price of 28. Whatever I get, I subtract -1. And somebody in this case give me this figure in form of percentage. Somebody give me this figure in form of percentage. Remember, it has to be P1 over P0. Price of the most current year. And now when you compare 2020 and 2019, 2020 is the most current year. So take the most current year's price divided by the oldest price, and then whatever you say after saying equals, you say -1 times 100. What figure we get it? Somebody there, please help me out. What figure we get it? Yes, and gentlemen, please help me. Please help me out. Yeah, so minus 10.7. Thank you. Then come to 2021. So 2021, what is going to happen here? 2021, what is going to happen? I can see 2021's price is 18. I divide by the previous year. Previous year now is 25. Previous year's price is 25. So I divide this by 25. Whatever I get, I say -1. Whatever I get, I say -1. P1 minus P1 divided by P0. Right. You know, now we're looking at yearly price increases. Yearly price increases or decreases. Yearly price increases or decreases. Or decreases. So Jumo is telling me when you write this as 10.71, 2 decimal places are better. 2 decimal places are better. Then I'm putting my figures in percentage up there, so no worries. So now we are in 2021, but this is 2020. So you're getting in this case here price increases or decreases on a yearly basis. On a yearly basis. So according to rules, we have here minus 28. Can somebody confirm that figure? Can somebody confirm that figure? You must confirm it. If you're following, for 2022, I will take what divided by what, if you're following. 2022, I should be able to take what divided by what. 2022, I should be able to take what divided by what. Somebody is following for 2022. Because normally a change. It's normally a change. Yeah, it should be 22 divided by the immediate predecessor, who is 18 there. Whatever I get, I take away 1. Whatever I get after I take away 1, I multiply with 100. Whatever I get after I take away 1, I multiply with 100. 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 So according to 𝗏𝗏𝗏𝗏, we are getting 22.22. 22.22. Thank you so much. 22.22. 22.22. Then can you kindly do for me 2023? Please do for me 2023. Please do for me 2023. Please do for me 2023. And what we have there in 2023. So 2023, this is what we should have. 2023, it will be 28. We divide this by 22, the immediate predecessor. All right. We take away 1. Whatever we get times 100%. Whatever we get times 100%. Whatever we get times 100%. So you can never have returns in form of Kenya shillings. We can never have return. Any return on investment returns from what we invest will always be given in form of percentage. Will always be given in the form of percentage. That is where most students were not able to really scratch the surface. Not able to get their hands around it. But returns must always be in form of what year? Kenya, or rather must always be in form of what year? Percentage. Percentage. So then are you able to give me the figure, ladies and gentlemen, the first one here? So I'm being given 27.27, isn't it? 27.27. And then now they wanted expected return. So come and give me the expected return. So expected return is the average. This is the average. So it should be 27.27 plus 22.22 minus 28 minus 10.71. So we divide this by how many numbers? So we divide this by how many? We divide this by how many? You can see the first one, what is going to be 5 because the first one is a technical knockout. You know, this is not 0. If it was 0, fine. You know, this one here we could not compute because if you take 28, look at this. If you took 28 divided by the immediate predecessor here is 0, and then you say minus 1, it will give you infinity. Even if it gives you 0, that's another case. 0 is a number. But now this is not 0, this is infinity. It cannot be 5. So in this case, we need to come and divide this by what year? By 4 numbers. By 4 numbers. So divide this by 4 numbers. So what are we getting, ladies and gentlemen? I hope you'll be able to understand. What are we getting here, ladies and gentlemen? As the expected return per annum. Expected return per annum. What are we getting here as the expected return per annum? So according to Walter, we are getting 21.5 what year? 21.5. Are you sure? Remember, others are what year? Remember, others are negatives. Others are negative. So if I were you, what I would have done, I would have first of all, in this case, here gotten this numerator. I write the numerator. And then at the end of the day, I will be able to divide by what year? I will be able to divide by 4. I will be able to divide by 4. I will be able to divide by 4. At the end of the day, I will be able to divide by 4. I will divide by 4. So is there someone who is getting 2.6 something? Yeah. And if you look at the answer given for 2.7 years, if you look at the answer given, if you look at the answer given, well, all right. So are you able to see the answer here? You can see 2.6 something, 2.9, like that. Oh, yay. So what have you learned, ladies and gentlemen, out of this? What have you learned, ladies and gentlemen, out of this? What is your take home out of this? Because you know, it's not your usual normal class. This one we must have reflections. Because we don't want to get ourselves in that situation where we fail again. No, just pass. And these questions, if you're seeing the way the examiner is setting them, you need deep understanding. You need deep and broad understanding. Yeah, that's n-1. And that n-1 is not because of the small sample, no. Here, basically, n-1 has come because of what you were not able to get this number. Did you try, in this case here, BK, to say 20 divided by 0 in your calculator? If you say 20 divided by 0, are you going to see it is infinity? Or error, math error? Yeah, this number is qualified as. If it was 0, and I did this in the last class, remember the first question we did, we had a question where we had a 0 here. These are counting the rate of return. If you had a 0 here, 0 is a number in statistics. 0 is a number in statistics. 0 is a number in statistics. My key learning, because I also learn as I teach, is that I will always ensure that my returns are in form of what here? Percentage. Remember portfolio theory. In portfolio theory, your returns can never be in form of money. Your returns can never be in form of money. Yeah, expected returns without probabilities. Thank you very much. So expected returns without probabilities. If we had the probabilities, you're right, Walter. I would have taken yes, expected return. Expected return. Like that. Summation of x times probabilities. In the absence of probabilities, we shall add the returns you have, and then you average by dividing with n. Thank you so much. Thank you so much. Thank you so much. Now, ladies and gentlemen, do you think these classes are good for you? Do you think these classes here will be able to add value for you? Or do we take the few students who are in our special edition, we put them together with our normal class students? Do you think these special edition classes can add value to you? Or do we put you together with the normal students? They're not giving me responses. They are not giving me responses. Adds much value. Yes, adds much value. So then you have to promise Mwalimu one thing. Because you know me, I don't know how to market at all. But I know you guys really know how to market. So please get out there. Anybody who has failed this FM paper, bring them here. I'm so sure even there are students who are in the normal class, all right, and they had failed. So they're normal class and they had failed this paper, and they're interested, we shall transfer them live here into this class. So that this class can at least get 50, 100 students. That really will be very, very good. That really will be very, very good. So if there is anybody who is here with us and they are not registered yet, they need to come and do what here? They need to come and register with us. They need to come and register with us. And our number is 0719 525. Our number is 0719 525 000. 525 000. These are numbers. Valuable. Great. Then we shall strive to do them even at a better level. This is our number. But most importantly, I need this class to be full. I need this class to be full. Yeah, so PA, we should be able to add new PA if you don't mind. That's very good. Please reach out to me with your payment message later on. reach out to me with your payment message, then I'll be able to add you. That's my personal number. Yeah, you see like Ruth, like Ruth is in the normal class. If you, with your permission, Ruth, we should go to transfer you. You simply go to your normal class, tell us there, transfer me to special education, and then you tag me. You tag me there. I'm able to see, you tag me there. All right. Because honestly speaking, a normal, or rather somebody did this paper and failed, you should not be in the normal class taking normal notes. You know, like 𝗦𝗣𝗘𝗖𝗓𝗓 told us that if you continue treating this thing normally, then we expect to die. Because it cannot be business as usual. This should be a class where we are only tackling past paper questions. We are only tackling past paper questions, and of course those sensitive areas. All right. So then I'm not going to succeed. Remember, I'm trying to ask myself, if I were the student here, what would have I really done here? What questions would have I tackled very, very well? Yeah, we shall have put them in the area.